Welcome back. Welcome back to Accounting 101. In this video, we are going to go over the effective interest rate method of amortizing bond premium or discount. What I am discussing can be found in Appendix 12B that begins on page 12-28 and I believe continues on page 12-30. The effective interest method of amortizing bond premium or discount is how it is done in the real world. The book uses the straight line method in the body of the chapter and puts this in the appendix. It should actually be the other way around because the effective interest rate method is how it is done day in, day out in the real world. And the straight line method, in my opinion, shouldn't even be in the book or taught because nobody does it. It relates to the straight line method we saw in Chapter 9 for depreciation, but again, the banks don't do it that way. Nobody does it that way. So I can't understand why they have it in the book like that. But anyway, we are going to use the data in the two exhibits in the appendix 12B. One is the discount, selling bonds at a discount. The other one is bonds at a premium. If the bonds sell at face value, obviously there is no premium or discount, so you don't have to worry about amortizing the discount or the premium and their effect on interest rates. Interest expense. Now we know already, or we should know, that when a bond sells at a premium, it sells for less than its face value when it's originally issued to the investor. And that means the interest payment, which is fixed by the face rate of interest and the face value of the bond, is going to be different than the interest expense we recognize because we have to amortize the premium or discount, and we do that by adjusting interest expense upward or downward versus the interest payment. Interest payment and interest expense are two different numbers when there's a premium or discount involved. They'll be the same thing when they sell at face value, but that's rare. Rare that they sell at face value. So if you sell at a discount, the interest expense is going to be greater than your interest payment. If you sell at a premium, if the bonds sell at a premium, the interest expense is going to be less than or lower than your interest payment. Now, the interest payment is calculated, as we said just a few seconds ago, the face value of the bonds times the face rate of interest on the bonds times the portion of year, usually twice a year. So if you're paying that amount on an amount less than face value, your expense is going to be greater. If you're paying that amount on an amount greater than face value, your expense is going to be lower. It's just, common sense and mathematics. All right, let's get to see how we do these things. Yeah. Come on, scroll down. Yeah. It turned 4 pages on me. Oh, now we went back to what we should be. No. One back. Well, no, one ahead forward, one back 5. All right. This thing will not move. Okay, the first one they go after is using the effective interest rate method when the bonds sell at a discount. So I'm going to use the form that we're going to see on the exam. Let me get it on the clipboard here so it doesn't bend as easily. So you can see we have 1, 2, 3, 4, 5, 6, 7 columns on this form. The first one being for the date. I didn't name that one. I'll have the dates typed in there on the final exam. But we have column A, B, C, D, E, and F. And then on the bottom I have a legend of how to compute each one of those things and where the numbers come from. But the first one is a carrying value of the bonds at the beginning of the period. And the period we're talking about is the interest period, the 6-month intervals. Then we have interest payment, and that's easy. That's how, once you calculate that, face value of the bond times the face rate of interest times the proration of the year, that number stays consistent all the way down that column. And again, what I'm going to do on the final, I'm going to show you something like this where you don't have to do the full thing, you just do the first 4 or 5 rows, or I haven't decided yet. I have to decide how many points I need to build in there. And then we have the interest expense. The interest expense is always going to be the carrying value of the bonds from column F times the market rate of interest prorated for half a year. The amortization is going to be the difference between column B and C. And that amortization is going to be how we get rid of the premium or discount over the life of the bond each time we pay interest, because we want those two accounts, discount on bonds payable or premium on bonds payable, to be equal to 0 at the maturity date. So the maturity value of the bonds is a face value, 100,000 or a million, whatever it is. I put column E in here. It's a little bit different than the book, because then you can see what the premium or the unamortized premium or discount is. So on the first row, that's going to be the total, the difference between the proceeds and the face value. And then we have the carrying value. The important thing to remember, and this can be a self-checking mechanism for the exam, is columns E and F. If it's a discount, add E and F, and you should get the face value of the bonds. If it's a premium, you subtract E from F, and that will give you the face value of the bonds. So if we're dealing with $1 million worth of bonds, adding the unamortized discount to the carrying value should equal $1 million. If we're dealing with a premium, whatever the book value should be the less the unamortized discount. I'm sorry, the unamortized premium should be the face value of the bonds. All right. So I'm just going to put on my pen here the information they gave us. $100,000 worth of bonds. Pen's not working. I don't want to use that one. Let me grab a better pen here. All right. So in both cases, we're going to be selling face value of bonds is going to be $100,000. All right. And the discount equals $3,851. $3,851. And the face rate of interest on the bonds is 9%. And the market rate of interest is 10%. And then we have 5-year bonds, 5-year life, and pay interest 2 times per year equals 10 payments. So yeah, I got an extra row or 2 on the table. Let's see. Okay, Exhibit 12B. Again, this table mirrors it a bit, but I have, instead of cash paid, I have interest payment, interest expense. I agree with them there. I have a column for amortization. They call it discount amortization. On the other one, they're going to call it premium amortization. I don't want to say whether it's one or the other on the final, because that's going to be one of the questions, whether the bonds sell at a premium or a discount. And then I have unamortized discount or premium. Again, I don't want to disclose which one it is because you're going to have to tell me as a response to one of the exam questions. And then we have the carrying value of the bonds. Okay, so we start off here. I'm going to change the dates again so it'll be more reflective of the exam. They're using bonds being sold on January 1 of 2024. I'm going to use October 1 of 2024. All right. So I'm going to stop the tape, and I'm just going to fill in all the columns down here with the dates all for every interest payment. So I'll be back in a, well, you won't know how long because I'm going to stop it and then I'll start it. It'll probably take me a minute or two. So I'll be right back. Okay, I'm back. So here I have October 1st, 2021, March 31, 2025, October 1, 2025, March 31, 2026, so on and so forth, down to October 1st, 2029. So what do we have here? 1, 2, 3, 4, 5, 6, 7, 8, 9. What am I missing? Did I miss one? Let's see. March, October, March, October, March, October, March, October. Oh, I didn't put March 2029. Okay. All right. So I'm going to alternate colors here. So you can have the first year of the bond, the second year of the bond, the third year of the bond's life, the fourth, the fifth. It's good because I'm counting the interest periods. So October to October would be year 1, 2, 3, 4. So again, each 2 lines is 1 year in the life of the bonds. Now the bonds sell for $96,149. So that's the carrying value, book value, when the bonds are issued at the beginning of their life. Okay, that's equal to the proceeds from the initial sale of the bonds. So what I'm going to do now is I'm going to put in the unamortized discount of $3,851. And now, as you can see, the total of columns E and F is equal to $100,000, which is the face value or maturity value of the bonds. Sort of a little built-in self-check mechanism if you want to use it. Now, the other columns here have nothing in them because this is the initial moment of the life of the bonds. No interest has accrued, no payments have been made. The only thing is we sold the bonds, we got paid for the bonds, $96,149. 5 years from now down the road, we're going to have to pay back the bondholders the full $100,000. So we're going to have to amortize that $3,851 discount each time we make an interest payment because it's going to impact it. In this case, it's going to raise our interest expense is going to be greater than our interest payment. Again, the interest payment is computed by taking the face value of the bonds times the face rate of interest on the bonds times the half a year in this case. So let's do that now. Interest payment column. You can see I put it in column B, and that is going to carry on all the way down that table. Because the face rate is printed in ink, doesn't change. The face value of the bonds is printed in ink, doesn't change. So you can see I have 10 payments, one payment every 6 months of $4,500. Now, where do we get column A from? Column A, the beginning of that 6-month period, the book value is going to be from column F on the previous row. So we just bring this down. The ending of the previous period is the beginning of the next period. Well, there it is right there. Now, what do we have to do to get the interest expense for the March 31, 2025 interest payment? Well, interest expense, I'm just going to call it INT-EXP, interest expense equals the carrying value of the bonds times the market rate of interest times half a year. I'll write that right down there. Interest expense equals the carrying value of the bonds times the market rate of interest times half a year. And that's going to change every time we pay interest because the carrying value is going to change. So our carrying value on the previous row, or if you want to look at the column A of the current row, 96,149 times the market rate of interest of 10%. Yeah. Turn the calculator on. Be better than that power. And I get 4807 rounded. It's 4807.45, but we're going to round to whole dollars here. That's the interest expense. Yes, we're paying the bondholder $4,500, but we're paying it on the fact that they only gave us $96,149, not the full $100,000, because they sold at a discount, because the market rate of interest is greater than the face rate of interest on the bonds. Right? So now the amortization is going to be the difference between the interest expense and the interest payment. In this case, That's $307. I took the 4807 in column C, subtracted the 4500 in column B to get the 307. Now, what is that 307? That's the amortization, in this case, the amortization of discount. So it's going to reduce column E by 307. And that becomes 3544. And it's going to increase column F. And that becomes 96,456. Now, if we combine those two numbers, we do that little self-check I talked about, and you can see my calculator says $100,000. And again, if you want to look at these two things as a T account, well, you wouldn't have the carrying value. There would be the T account of $100,000 less the discount of $38.51. And every time we pay interest, this discount is, some of it is going to be amortized. We're going to whittle it down to zero at maturity. Okay. So as the discount on bonds payable modifies, there's a contra account to the liability account bonds payable that is recorded at their full face value in the T account of $100,000. The book value, the carrying value, are these two things combined, has got to equal the face value. As the discount goes down, the carrying value goes up. So, how do we get column A for the third row? Well, we go to column F of the second row and bring it down. One period's ending becomes the next period's beginning inventory. Okay. We don't have to mess with that interest payment because we computed that right off the bat, and that's going to be a constant $4,500 for all 10 payments. So now the interest expense, we got to recount, we got to do another calculation. And again, the definition, the formula, I wrote it down on the bottom there. It's not going to change. It's the carrying value of the bonds times the market rate of interest times half a year. So what has changed here? The carrying value of the bonds has gone up by the amount we amortize it on for the first interest payment. And I have the way I've devised the table, it's right there for you at the column F of line of row 2 or column A of line 3, row 3. So either one, they're the same number, 96,456 times 10% market rate of interest times half a year. And I get $4,822.80. I'm going to round that up to $4,823. Which agrees with Exhibit 12B1. Now I take the difference between that and the $4,500 interest payment, and I get $323 for the amount of discount that we're amortizing for this 6-month interval. So now that $323 is going to reduce the discount, unamortized discount, and increase the carrying value. So I'm going to subtract it from the previous row's column E. And add it to the previous row's column F. Okay, so there's the $4,500 interest payment. There's the $48.23 interest expense. The difference is $323. So I subtract that from the unamortized. That's the amount of amortization for that 6-month interval of the discount. So I update the unamortized discount by subtracting that from the previous row's amount. And then I update the carrying value of the bonds at the end of that second interest payment interval by adding that amount to the previous row, column F. And that's as simple as it is. What I'll do is I'm going to stop the tape. I'm going to work all these out, and then I'll post it back up and hold it up there for 30 seconds. Or when you play it back, you can stop the video and copy them down. $23, $40, $39. $56. $74. $92. Okay, here's the completed amortization table. As you can see, the amortization, the unamortized discount gets down to zero. Each time we pay interest, it gets whittled down by the amount of the amortization on it, which is the difference between the interest expense and the interest payment. And as it goes down, the book value of the bonds payable goes up. So here we are at the end. The amortization is, the discount is completely amortized, and the carrying value is equal to the maturity value of the bonds. Okay. Pull that up again if you guys want to look at any of the numbers. So if you'll try to do it yourself, you can do it. And be careful when you're completing this. Again, I screwed up on two of these. My eyes aren't that good. I took the wrong row when I brought them over from the previous. So if you can't make out those numbers, you can just go up one row and over to column F, and that number comes down. Sorry about that. Okay, now let's talk about how we use these numbers. On the exam, we're going to have to answer a couple questions. First one is, give you a scenario and ask you if the bonds sell at a premium or discount. You can answer that. And then I'm going to ask for an entry to record the sale of the bonds, which in this case, they sold for $96,149. And again, I'm going to do this piecemeal. So I know that's going to be the cash coming in. So it's a debit to cash. The bonds payable, I always recorded at face value, $100,000. Okay, and as you can see, I purposely left the line in between those two accounts and amounts because I know they didn't say sell at face value. I'm going to have to put a premium or discount, and in this case, it's a discount of $38.51. And again, you can determine that it's a discount because the proceeds from the sale, $96,149, was less than the face value of the bonds. So if they sell for less than face value, it's a discount. If they sell for more, it's a premium. Now, the reason they did that is the market rate of interest was 10% and the bonds were 9%. Market rate is higher, bonds will sell for lower. All right, now we want to do the entry required on December 31st. So this was 10/1/2024. At December 31st, 2024, we have to do an entry for the accrued interest for 3 months. Well, our first interest payment, if you look at this table we just did, is March 1st. March 31st. End of March. Yeah, March 31st, I have it. Okay. Is a 6-month period. Trouble is, the end of 2024 bisects that 6-month period. 3 months are in 2024. 3 months of the 6-month interval are in 2025. So we're concerned with October, November, December of 2024. What's happened? Well, the only thing that has happened is we had an accrued expense. An expense that has been incurred but not yet recorded. It's going to be interest expense on the bonds, and it's going to be equal to half of the March 31, 2025 numbers. Okay, so we're going to have interest expense. And let's see, the interest expense was $48.07. Divided by 2, half of that is going to be $2,403.50. Let's call it $2,404. $2,404. Okay, we know the amortization is going to reduce the discount on bonds payable. So let's set that up as a credit. All I did is write the account in there. I know it's going to be a credit because it's got to be reducing it. How much is it reducing it? Well, with the amortization for the period October 1, 2024 through March 31, 2025 is $307. But we only want 3 months of that 6-month interval, so take half of it. Yeah, it's 153.50. Let's call it 154. And there we have an entry that has more debits than credits. So 2404 less 154 is going to be $2,250. And maybe by now you can contemplate what that is. That's our half of our first interest payment of $4,500. It's going to be paid on March 31 of 2025, but we are at December 31, 2024. So let's call it what it is: interest payable. And there's the adjusting entry needed at the end of December of 2024. Now let's go into March 31, 2025, when we make our first payment. Cash of $4,500 is going to be paid out to each and every bond holder. Or not everyone, to all of them, to all the bondholders. If somebody bought the whole $100,000, they're going to get the whole $4,500 payment. So part of that payment is going to be interest expense for January, February, and March of 2025. It's going to be the second half of our interest payment right here. Our first interest payment, March 2025, half of it. So it's going to be the same that it was at December 31, 2404. Because we had 4807. Well, you know, make it 2403. It doesn't matter. On the exam, if it's off $1, I'm not worried about that, because I write on it, I have please round to whole dollars. All right. So I'm just going to use it here we rounded up at December 31. We're rounding down at March 31. 50 cents more one place, 50 cents less the other. Now, part of that payment, part of this $4,500 payment is going to satisfy that liability interest payable from December 31. Of $2,250. So let's see what we have here now. We have 2403 plus 2250. That equals, I'm just going to write it down here, 4653. The difference, the missing link here, is the difference between the $4,500 and this 4653, which is $153. So what does that look like? Well, that's the other half of the amortization of discount from the first 6-month payment interval. We have 154 up here for October, November, December of 2024. Here, because we rounded, here we're going to round it for January, February, and March of 2025. And that is going to be the amortization of the discount. So discount on bonds payable. And the entry balances. Okay. And again, I don't know if I'm going to ask you to do much more than that on the exam. Probably not. But if you do, the numbers are in the table. You just have to, well, no, let's do one more because it'll be different. It'll be for the full 6-month period because it'll be October 1, 2025. We're going to have, I'll put it down here. October 1, 2025. We're going to have interest expense. We're going to amortize some of that discount on the bonds payable. And we're going to make a payment. Okay. So here's the entry down here. I didn't have enough room up there. So we're going to have interest expense. We're going to have a disbursement of cash. And we're going to have a amortization of discount. So the interest expense will come right off the table. Circle it in right there for that line. October 1, 2025. Our interest expense is $48.23. The discount amortized is $323. And the cash payment, interest payment is $4,500. So there you can see the entry. $4,500 payment, interest expense $48.23. The balancing number $323 agrees with the amortization of the premium or the discount. In this case, it's a discount. Why didn't we have to do it prorated for 3 out of the 6 months? Because this is in the same year, 2025. The next one, December 31, 2025, we're going to have to do an adjusting entry for the half of the next interest payment that is going to be March 31 of 2026. Okay, let me get another table ready here for the premium. I got a other computer here timed out, so I've got to go back in here. Hey, and it came up where it should come up. Let me turn the page while I'm over here at the other computer. And now we have a situation where the market rate of interest has changed, and it changed for the it went down. So face rate of interest is still 9% on the bonds, but now the market rate of interest is 8%. So in that case, it means the bonds are going to sell at a premium. And it tells us here, same thing, $100,000 worth of bonds face value, 5-year bonds, 9%, market rate of interest, 8%. So the bonds sell for $104,100. So the difference between the face value, $100,000, and the proceeds from the sale issuance, $104,100, that $4,100 is the premium. So I'm not going to put the dates in. You can copy them down from the other one. Well, yeah, October 1, 24, March 31, 25. I'll just do a couple here. October 1, 25, and March 31, 26. So the beginning carrying value of the bonds is what they sold for, the proceeds, 104, 100. And the premium is the difference between that and the face value of the bonds. Oh, this thing is terrible. So the unamortized discount at the outset is $4,100. Now before, you had to add the discount and the carrying value to get the face value of $100,000. When it's a premium, you subtract the premium from the carrying value to get the face value of $100,000. So that's your self-checking mechanism. So once again, column A will always come from column F of the previous row. So that 100 comes down to the second row, column A. Interest payment. Oh, I should have done that. And again, it's going to be a constant $4,500 all the way down. And that doesn't change. What changes is the interest expense. And again, the formula is the same. It's just now that it's a premium. So we have $104,100 times the market rate of interest, which is 8%. And that will give us an interest expense of $4,164. And you can see that in in exhibit F 12B-2 on page 1230. All right. The $4,164 is the interest expense. Notice when we had interest payment, well, we're in the opposite situation now. We're dealing with a premium. So our $4,500 payment is based not on $100,000, but on $104,000 that the investors paid us. So our actual expense is going to be less than the payment, $4,164. How did I get that? 104 carrying value of the bonds, $104,100 times the market rate of interest of 8% times half a year, and that's where you get the $4,164. Now the amount of amortization, in this case amortization of premium, is going to be the difference between those two numbers, the payment and the expense, and that is $336. And that is going to reduce the unamortized premium in this case. It's going to make that $37.64, and that's going to drop the carrying value to $103.64. All right. So the amortization is the difference between the payment and the expense. That's the amount of premium we're going to amortize for this interest payment. And it's going to reduce the premium, and it's going to reduce the carrying value, because once again, we want this to hit 100,000 and this to hit 0 at the end. Oh, one thing I neglected before, oops, I almost knocked the computer off the thing. If you added up all these amortizations of the discount in the previous example, that would add up to, guess what? $3,851, the total amount of the discount, because you're amortizing it each and every time you pay. Okay, so now, how do we get column F for row 3, or column A? You get it from column F, row 2. So we have a new carrying value. We're going to get a new interest expense. It's going to be different. Should be lower, I think. Yeah, because the carrying value is lower. The interest rate is still 8% in the market rate of interest. I get $4,150.56. Let's round that up to $41.51. So we'll agree with the table or the exhibit in Exhibit 12B-2. $41.51. $41.51. The carrying value times market rate of interest times half a year. You want a shortcut? The market rate of interest is 8%. Half of that is 4%. Just take 4% times the carrying value. Do one computation instead of two. Do one in your head. So now the amortization of the premium would be the difference between the $4,500 payment and the expense of $41.51, or $349 of premium being amortized. And again, what we'll do is we'll subtract that $349 from the unamortized premium of $37.64 minus $349. We'll get $34.15. And it's going to be 103. Carrying value of the bonds are going to be 103,415. I'm taking that right out of the Exhibit 12B-2 in the book. Okay. What I did is I took the amount of amortization for this 6-month payment interval, subtracted it from the previous unamortized premium to get the new, and the carrying value. It's got to go down. Both of these are going down by this amount. So let me work one more through. 103,415 was the ending carrying value for the previous interval. Times the market rate of interest times half a year. And I get interest expense of $4,136.60. I'm going to round that up to $4,137 to agree with what's in the exhibit F12B-2. So now the difference between that and the $4,500 interest payment is $363. It's $363.40, but I'm going to round it to $363. Okay, $4,500 payment doesn't change. The interest expense does. The interest expense is now the carrying value times the market rate of interest times half a year. The difference between the payment and the expense is the amount we're going to amortize this interval. So once again, I'm going to take that 363. I'm going to subtract it from the previous row's unamortized amount of $34.15. It's going to give me $3,052. And if I look at the fourth entry in the column, the last column carrying amount for June 30th, 2025, according to them, it's 103.52. So yeah, that agrees. If I subtract, here's the new carrying amount. All I could do is take the previous carrying amount, subtract out the amount of the amortization. Well, in this case, here you're going to subtract it from both of these. You subtract this from that, you're going to get the $100,000 face value. You're good to go. That's a self-checking mechanism. Let me shut down the tape. I'll continue to fill out this grid, except for the time. I'll do the times too. Just let me stop it here. I'll be back in a little bit. Let's see, March, October, March, October, March, October, March. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 1, 2, Oh, 2674. All right, got all the dates and numbers and everything in. Again, these numbers, if you can't understand my writing, you can look on page 12-30 in Exhibit F:12B-2. The interest payments, the interest expense, the amortization of the premium, and the carrying value for row F. And then, row F just repeats one, or column F repeats one row down in column A. And I have that unamortized premium. So it's just the subtracting that amortization from the previous row's amortization in column E. And that's it, except to do the entries. So in this case, the cash coming in on October 1, 2024 is $104,100. We have the bonds payable, always recorded at their face value, in this case, $100,000. And to show you how simple it is, I did 2/3 of the entry. We need a $4,100 credit to balance. And since it's the same balance as the liability account, bonds payable, it's an adjunct valuation account, so it would be premium on bonds payable. Once again, December 31, 2024, we're going to have to do an accrue for the interest expense. Interest payable, I already know what that's going to be. It's going to be half the $4,500, or $2,250. Okay, so I go to my table for March 31, 2025. I see the interest expense is $4,164. So half of that applies to the last 3 months of 2024. So $4,164 divided by 2 is $2,082. Okay. This is half of the $4,500 payment that's going to be made on March 1, 2025. This is half of the interest expense of $4,161 that's going to be paid on March 31, 2025. But this is the expense, half of one, because there's going to be 3 months in 2024, October, November, December. So we take half, and half January, February, March of 2025. We'll get that when we do the next entry. So the difference there, I'm short a little bit. And let's see, 2250 less 2082 is $168, which, if I take the amount of the amortization for the first 6 month interest payment of $336, I get $168, and that would be the amortization of the premium. So we go premium on bonds payable. That easy, yes, it is. So now we go to March 31, 2025, when we're making the first payment. Yeah, so how much am I going to pay to the bondholders in interest? $4,500. That's the payment. Now, I have to recognize interest expense for January, February, March of 2025, or the other half of this $4,164, which is $2,082, identical to the first 3 months of that 6 month payment interval. Call it what it is, interest expense. Part of that $4,500 disbursement is going to satisfy the interest payable that came in to Bean when we recorded the accrued interest on December 31, 2024. Interest payable. So let's see what we have here. I have 2082 plus 2250. I have 4332, if you can see it here. And I'm paying $4,500 out in cash. So I'll change that, 4,500. The difference being $168, which is what? The second half of that amortization of 336 on the fourth line of the amortization table is column D. Premium on bonds payable. let's do the October 1, 2025 payment. Cash, $4,500. Interest expense, October, the interest expense was $41.51. And the amortization there would be $349. October 1, 2025. What's that? The first one is the expense. The next one, $349, is the amortization. So, premium on bonds payable. There it is. Didn't have to do a proration because that is for the period of April, May, June, July, August, and September. A 6-month period. The second 6-month interval, the second payment that covers the 6-month period from April 1st through September 30th, paid on October 1, 2025. Didn't have to do any accrual because it all occurred within the same calendar year, 2025. All right, you do that. Try to do it again on your own. Go back to the tape if you get stuck, and it would set you up well prepared for the final exam.